Thus far, the weakness we've experienced in the stock market has had little impact on the bullish trends. However, momentum has been slowing, and as we'll discuss in the video, needs to be watched to make sure it doesn't morph into something more concerning. Repeat customers know that the market model helps us monitor proven methods to manage risk. How you do that, you pay attention to what is happening and make allocation adjustments as needed. In this video, we will look at what happened this week and what is happening. Another advantage to using a mechanical system with firm rules is it makes you take an unbiased look at the markets. We'll look at all the major U.S. indices, daily, weekly, monthly in the video. We'll update you on the output from the CCM Market Model, cover the CCM Big Four charts that are inputs into the model, make some comments on what tech is telling us, what we're seeing in small caps, and look at European and Far East and Australia relative to the emerging markets. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. We'll kick off the chart and technical portion of this week's video looking at one of the sub-models for the CCM Market Model, CCM Correlation Model that we've looked at numerous times in these videos. Quickly, these are the charts that we look at. These scores summarize numerous indicators and trend-following methods. A week ago, August 2nd, the composite score for all of these charts weighted was a very high and bullish 98. The highest score you can get is 100. We did see about a 20% drop from last Friday to the close on Friday, August 9th. And what does that tell us? It tells us that we have slowing momentum. It's not overly significant. That number is still pretty far away from a 50 where you would become more concerned. But there was about a 20% decrease in the number of technical indicators that were registering an answer of bullish. So momentum is slowing, and it's something that we have to pay attention to. How did it impact the allocation recommended by the CCM Market Model? This is the master spreadsheet for the CCM Market Model. To learn more about the models, you can visit our website, and you can also watch videos from the previous month or so that will explain a lot of what we're looking at here. The net of the model is one portion of it gives us an allocation. So as of the close on August 9th, which is a Friday, it recommended an 87% exposure to risk, so stocks, bonds, commodities, gold, silver, and a 13% allocation to conservative assets similar to bonds or cash. How has that changed from a week ago? From a week ago, it recommended a 98.2 was the mix. We never went up that high. We actually stayed around 91 from this point here to this point here. The model does give us a little bit of leeway, especially when it gets up to these high levels. Yesterday, on Thursday, August 8th, the recommended allocation was 91%, and that's exactly what we carried into the week. So as of Thursday's close, we were right on the money. As of Friday's close, we're slightly over-allocated, but still within the rules. The way the rules work, if deterioration continues, and this number is at 87 or below next week, we'll start to incrementally step away from risk. And why do you do that? We don't know if the peak from last Friday was a peak that will last 3 days, 3 weeks, 3 months, 3 years. So you begin to step away and reduce risk. If it's a 3-month correction, we will have reduced our risk exposure significantly. Even if it's a 3-week correction, it's worth stepping away. You can always step back in. And you can see here, going back to mid-July, The model had us step in so we could participate in the gains, and now it's taking an incremental move away from risk. It takes an incremental step also from a bullish perspective. It admits that you could be wrong. The market could regain its footing next week and start to rise. If that's the case, we still have long positions and we can participate. So we'll migrate either way from here based on the model output and the input from the markets. And looking at the previous spreadsheet, we said that the model tells us a recommended allocation between conservative and more aggressive or growth-related assets. This is somewhat of an inside look to the other half of the model that helps you select what growth assets to plug into that allocation, and it works the same way on the conservative or fixed income side. This is the Emerging Markets ETF, EEM. It's a weekly chart relative to the S&P 500. The rationale is we'd prefer to get into positions that are in this area here, beginning a new bullish uptrend versus the S&P 500, where emerging markets here are outperforming. Purpose of the exercise, emerging markets may be a good proxy for where the market's going over the next few weeks or even months. This is 2008, and you can see here emerging markets started to pick up the pace before the stock market bottomed in the spring of 2009. It's rare that you see an oversold situation here where emerging markets are this weak on a weekly RSI basis relative to the S&P 500. Doesn't happen very often. Here is even worse. So what it's telling us is if emerging markets over the next few weeks can turn and get out of this oversold state and get more into a state like this, A, it obviously would be good for emerging markets relative to the S&P 500, and B, it would probably point towards markets that are looking more at a reflation or cyclical trade than they are looking at deflation. So this is what deflation looks like during the 2008 financial crisis. Typically, emerging markets is more of a risk-on asset, and it underperforms. You can see it bottomed relative to the S&P 500 early and had a bullish divergence here when the S&P 500 bottomed here in the spring of 2009. So EEM will be watching closely for two reasons. A, we might buy it if it can look more like this or this or this. And B, we think it's a good way to monitor the risk-on, risk-off inflation versus deflation trade. We just noted that emerging markets are trying to pick up the pace relative to the S&P 500. The second component of our model compares alternatives head-to-head and eliminates alternatives. This is the emerging markets relative to the EFA ETF, which is Australia, Europe, and the Far East. You can see EEM is still in a downtrend relative to EFA, and EFA outperformed EEM by over 1% this week. Moral of the story, if we were to diversify outside the U.S. currently, we would lean towards Europe, Australia, and the Far East, and specifically Europe, an FEZ ETF, an EWP, which is Spain, and EWQ, which is France, also have good looks, turning looks like this relative to the S&P 500. Typically not risk off when Spain and France are outperforming the S&P 500, but keep an open mind. This is a weekly chart of the NASDAQ Composite Index that is used in the component of the CCM Market Model. The component is the CCM Market Risk Model, or affectionately known as the Risk Model. What we look at here is the slope of the 22-week moving average on the NASDAQ. When it's positive and price is above, good things tend to happen. When it starts to flatten out and price goes below it, bad things can happen. Currently, positive slope, price above. We also use momentum. Good things tend to happen when Williams percent R on a weekly NASDAQ composite chart stays in overbought territory. When it comes out of overbought territory, the probability of bad things happening increase. So on this weekly chart in isolation, everything looks good. Where most of the deterioration that we're seeing is coming from is on relative weekly charts, so a risk-on, risk-off chart, and your momentum indicators on weekly charts, but more so on daily charts. And we'll look at some now. It's a daily chart of the NASDAQ. This is momentum. You can see momentum is weak here. It's typically not what you want to see when negative 20. You can't recapture it. Here, some weakness followed. I like to see this up here. This is slowing momentum for the NASDAQ. Why do we still have a decent allocation, though? Well, the 50-day moving average clearly has a bullish slope telling us that the intermediate term trend remains up. The 200-day here in red, same thing. So this is positive from a trend perspective, and all things being equal, you try to leave your investments alone until something goes wrong or is violated that sends up warning flares. We just don't have that here. This is a little bit concerning, but these still look fine. Dow daily, same situation, but it's more vulnerable than the NASDAQ. This is the 50-day. If I zero in on this, the slope is still clearly positive, but you can see the momentum in the intermediate term trend is starting to wane, which is concerning. This still looks okay, the long-term trend, but price is quite a ways away from it. And here's the big one. On a daily chart, this momentum is very, very weak, and sometimes when Williams percent R gets below negative 50, you see some more weakness after that. Not a major red flag, but this is one of the reasons or evidence of slowing momentum and why some of the models have stepped back a little bit, because this is a little bit of a crack. Potential support here if we continue to see weakness next week. This is very similar to the opening chart of the NASDAQ. Now we're looking at a weekly chart of the S&P 500. Weekly momentum still overbought. That tends to be a good sign. Price above a positive sloping 22-week moving average. We've shown this chart before. What makes the market model and all the sub-models useful is simple matters and simple works. What you need is a way to keep track of these things and, more importantly, convert them into a very specific allocation and game plan, and that's what the models do for us. Point of showing this daily chart of the S&P 500, our first line of defense and the fastest moving average that we use in the models is the 20-day exponential moving average on the S&P 500. A concerning look would be price below it and the slope turning down. It's the blue line here. Price below it, slope turning down. Price below it, slope turning down. As of Friday's close, we're acknowledging some slowing momentum. Have to pay attention, but the slope of this, if we zero in on it, is positive and price is still above it. So somewhat the minimum bearish threshold has not yet been crossed. It may be crossed, but the way you use these models is you wait for observable evidence. This would be one thing that would act as a negative or subtract from the models rather than adding to it as it sits now. We've shown this long-term chart monthly of the S&P 500 several times. This is the year 2000, resistance. The bullish breakout that we've been following is still holding. It is possible that we come back and retest the blue line, but this still looks bullish from a long-term perspective. This is a weekly S&P 500 chart. Here's your weekly closing high for the May highs of this year. It's 1667. We still remain above it. It's possible if we see weakness that this area here could act as support. As long as we're above it, it adds to the bullish case. This is the weekly version of the 13-year breakout chart. S&P 500 weekly. breakout, retest, higher high. From a longer term perspective, this chart still looks bullish. We could come back and retest this line again. Rejected twice here. It's possible that we could make a double bottom under a bullish scenario. It would be very concerning if we lose this line and move into this area. So this chart continues to be important. Again, looking inside some of the components for our ETF selection models. This is QQQs, tech stocks relative to the S&P 500. That's what risk on or outperformance looks like for tech. That's what underperformance looks like. Point of showing it. Consolidation looks like a breakout. This still looks good for tech from a trend perspective relative to the S&P 500. And typically, all things being equal, when tech leads, that tends to be a good sign for the overall market. Currently, it is still leading. Everything that we just said about leadership for tech stocks also applies to small caps. Tends to be a good sign when small caps lead. The trend following component of the model tries to help you discern between volatility that needs to be respected, bearish moving average crossover, price below slopes down, and volatility that for the most part you try to ignore so you can capture the remainder of the trend. You can see as of the close on August 9th on this weekly chart, momentum, no big flags here yet, and this still looks healthy. Could we easily see it come down and test this line here at 100? Sure we could. We'll close this week's video with a quick look at the CCM Big Four charts that are used in the correlation model that we looked at in the open weekly S&P 500. The moving averages and price help us discern between volatility that we try to ignore and volatility that needs to be respected in here. Despite the give back this week, this chart still is in the volatility to ignore range. If it morphs into something like this or this, the models will start to step away and reduce risk. These can be multi-week or multi-month corrections. When we show the CCM Big Four, we have a tendency to focus on price and the moving averages because they're the heavyweights in the model. They matter the most, but we always look at indicator values as well, and the models have them weighted and scored, and that's how we get down to individual numbers. This is chart 2 of 4 of the CCM Big Four. It's the weekly risk on versus risk off S&P 500 relative to shorting the S&P 500 or SH. Still has a volatility to ignore look. If it morphs into something like this or this, which it may, we will begin to step away at a faster rate. You can see momentum on this chart is still clearly in the bull's favor. Can it change? It absolutely positively can change. But the point is, you don't guess, you don't get fearful here, you wait for observable evidence that will be captured in the math and by the models. You'll notice the models perform an opportunity cost analysis. Would I rather be long? Would I rather be short? Would I rather be in stocks or would I rather be in bonds? This is what I'd rather be in stocks looks like. This is the morph into I'd rather be in bonds. Stock market weak, I'd rather be in bonds. Stock market weak. Currently, some vulnerabilities here, but this still looks like I'd rather be in stocks. We'll keep an open mind, and if it morphs into something like this, the models will begin to step away at a faster rate. We'll conclude this week with chart 4 of the CCM Big Four. We're looking at junk or riskier bonds that provide a higher yield relative to lower yielding but supposedly more conservative treasuries. This is I'd rather be in higher yielding bonds. This is I'd rather be in more stable TLT treasuries. Currently, the answer to the question, would I rather own JNK or TLT, still is answered with JNK. We do see some vulnerabilities here, but really not that much different than the vulnerability here or here. We need to see it morph into something more like this, where the momentum also drops out of overbought, which is not the case as of Friday's close. We'll keep an open mind, follow the rules. If we need to step away, we have no choice. We will. The rules will make us step away. If we need to stay, the rules will allow us to do that. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.